please do concentrate. This is not too complicated. The very important is to be fully concentrated at the beginning to really understand what we are talking about. So what is this present value? This is the formula used in finance that calculates the present day value of an amount of money that you are going to receive in future. And the premise of the equation is that there is a time value of money. We just talked about it earlier. Time value of money is the concept that receiving something today is worth more than receiving the same item at future date. The presumption is that it's preferable to receive 100 today than it's to receive the same amount of money in a year from today. We know about that. So, discounting definition. What is discounting? We use this word discounting. The act of determining the present value of future cash flows. Again, it sounds very complicated, but because money is a subject to inflation, most likely, and has the ability to earn interest, $1 today is worth more than $1 tomorrow. So discounting is then the act of determination how much less tomorrow's dollar is worth by bringing this value to today. So present value and discounting in simple words, because we had the definitions, now in simple words. Then there is the assumption that there will be a receipt of money at a certain date in future. Saying even simpler, you will have some money in some time, say in 2 years, in 5 years. But the fundamental question is, how much is this money worth today? You will have it in several years, guaranteed. But how much is this worth today? So the amount in the future is stated in numbers. So the most likely there is a way of calculating this amount in future in numbers into today's reality. And the result of these calculations that brings this amount of money for today is called present value. Obviously, it's only a hypothetical number because you use some formulas and some rates to bring it to today, but it's sometimes needed or even obligatory for some management type of calculations and investment and other things. And these calculations to bring the future amount of money to the present value, they are called discounting. Like you have seen in earlier in the lecture, that we could bring by a special factor, we could bring today's value to future value. You are very smart, so you probably suspect that it will be a similar process with the future number, but by bringing it down by a certain factor. You are right. It is very similar process. Let us describe this process. The current value of future cash flow or cash flows discounted at the appropriate discount rate. And discounting refers to calculating the present value of a future amount. So if we know from the very first part of our lecture that value 1 equals value 0 multiplied by 1 plus r, if we want from this simple formula find v0, what we do? We just transform this formula. Obviously, it's very important to say that v1 is this value at time 1, sort of future, and v0 is the present value, and r is the interest rate. So when we have this formula on the left, V1 equal V0 multiplied by 1 plus R, when we transform it mathematically, it's V0 equal V1 divided by 1 plus R. You see it? Now we will have a more tangible example. Single period. In year 1, you are going to receive £100, but you know that the interest rate is 10%. So what you do? You discount this £100 by the factor. The factor is, as usual, 1 plus R, which is in this case 1 plus 0.1 means the factor would be 1.1. Brilliant. So the value, present value of £100 received in 1 year time at the interest rate of 10% is 100 divided by 1.1 means £90 and 90 pence. Clear? Hopefully it is clear. Now let us jump in our acceleration and our desire to find more about discounting into multiple periods. Assume again, in year 2 we will receive £2,000 and we know the interest rate is 10%. So when we discount it to the year 1, it will be 2,000 divided by 1.1. We already know from the previous slide. And we will come to the figure of 1,818.18. Brilliant. But this is still year 1. We have to discount it by a further year to the year 0, means to today. So we take the new figure, already discounted by 1 year, from year 2 to year 1, means 1,818.18, and we divide it again by the same factor, 1.1. So we arrive to the figure of 1,652.89. You are smart in mathematics, so you know that we would arrive to the same figure exactly doing the same thing like 2,000 divided by 1.1 square. So the answer, how much is the present value of the 2,000 received in year 2 at the interest rate 10%, the answer is the present value of this £2,000 is 1,652.89. Please remember this example, and we go to a general writing. So this is our general writing in mathematical way. V2 R percent. So V1 is V2 divided by 1 plus R, and V0 is V1 divided by 1 plus R, or V2 divided by 1 plus R square. Pretty clear. Obviously, just how in the previous situations we had, naturally, there is as well usually available a special table. Sometimes it's printed. If people do not have calculators, if they do not have Excel files, then the most likely they do it using these tables. So if we try to find a given number, then we use this. So if we are, say, at 5% discounting from the year 1, so what we have in 1 year time, we will divide this by a 1 plus 0.05 means the factor would be 0.9524. Alternatively, when we do the same thing and we have the period of 2 years, then our factor changes, because in denominator we use 1 plus 0.5 square. Obviously in numerator we have 1, so we divide by that, and the factor is 0.9070, and so on. Obviously, again, we could find easily that if we have this, like we bring this to a present value and say the number of periods is substantially higher, like 5, and then the interest rate would be 20, and we are expecting 1,000 in 5 years at the interest 20, this 1,000 received in 5 years would be worth now how much? Who would shout? Who would shout? Yes, you are right. 401.9. This would be this worth. So it's quite a small one. Just before we end the part 5 of our recording, there is a special task for you to calculate. Let us calculate. There is a very useful example. Obviously, we are not going to do always very simple calculations. Now it's a bit more interesting. Say, you would like to buy a new laptop in exactly 2 years. That is the assumption. So far, you have £1,000, and you expect that this laptop would cost £1,370. Then you find an investment, and at this investment you can earn 9% per year, per annum. The question is formulated in a way. In this way. Question 1. How much do you have to invest today to be able to buy the new laptop at the price 1,370 in 2 years? So how much would you have to put into this investment of 9% per annum to arrive in 2 years in this figure 1,370? And the question number 2, do you have enough money? As simple as that. Do you have enough money? And assume that the price of this laptop would be the same. Okay. So now, please make the calculations pretty fast, because what you would probably need to do, you know, because we will compare our answers. Please calculate right now, about a minute or something. It would be enough, I suppose, to calculate. Please write down these data, because they will be useful for the next task, means the homework, or we will do it live at our connection. So if the connection would be available, then we will do the next example live. But if not, then it will be some kind of a homework. So yes, please calculate. The period is 2 years. Laptop would cost 1,370. You find an investment to earn 9% per annum. For those who are still lost, you have to bring this 1,370, bring to now. Bring it, so you have to discount. Yes, you have to discount it and by this 9% per annum and to bring it to now. And then find the answer, do you have enough money? So still half a minute. Sort of like still a bit of time. All right. I suppose because we are running into a small delay probably. The answers. I hope you have the same. Because firstly we bring this 1,370 to today. So we divide it by 1.09 square because we have 2 years and 9% interest rate. So we arrive to the figure 1,153.1. So in order to have 1,370 in 2 years at 9% per annum, you need to invest 1,153.1 today. So this is the first answer. 1,153.1. The second question, second answer, you have only 1,000. So you compare the figure with 1,000 and then there is the answer. No, you do not have enough money. You are still short by 153.1. Brilliant. Now this is the homework. Just to say it very quickly, that everything remains the same. The only difference is that you found a better investment. It's 11% per annum. The questions are remaining the same. How much would you have to invest today? And do you have enough? So this is the homework. 2 years, 1,000 in hand, laptop 1,370. Instead of 9% per annum, it's 11%.